Yes, so welcome everyone to our tonight's session on money moves to follow. Very timely for the start of the new year coming up soon. My name is Sebastian. I'm the head of distribution at Syfe, and I'm a licensed representative of Syfe, and will be the host for tonight. Hayden will support me with some of the questions you might have. Feel free to use the Q&A tab at the bottom of your screen. If you're on desktop or even on your mobile, you have a Q&A tab as well. You can post your questions there, and we'll make sure to take some time to answer as many of your questions as possible. That being said, let us get started. And what we want to start today with is a little bit of an overview of the year. And as you all know, 2020 was a very eventful year. And we have put some of the events on this slide, and I don't want to go through every of these events, but I just summarize a few, and I think the top part really shows Singapore, and we had the first case here on the 23rd of January, followed by lockdowns and stimulus packages to try to revive and keep the economy going. And luckily, mid-June, we could move into phase 2, which allowed us again to go out. And luckily, it was announced like this week that on the 28th of December, we will enter phase 3, which comes with certain benefits compared to what we have right now. And this, all of these measures, prevented a lot of the things which you saw happening in many other countries. And this you see on the lower part of the slide, where you see that on the 28th of May, the US deaths passed the 100,000 mark. Global cases are around now 40 million. And we all know that the level of testing done in many countries is not like in Singapore, but there's a lot of cases which are probably not even detected. Luckily, there's also good news. Pfizer-BioNTech vaccine was approved in the first couple of countries. Also, Singapore announced that they will. This will be the first vaccine which will be distributed early in the new year, and a couple of other vaccines are coming as well. And how did this look in the news? It's a mix of very, very positive and very, very negative news. And we just picked a couple of headlines here around the stock market, which, there were part of it were the biggest drops we have ever seen in some of the stock indices, followed by some of probably the fastest recovery we have seen in the stock market, in the US stock market, and record highs and all-time highs, especially when it comes to the more technology stock like NASDAQ and so on. How does this look? And here I show the probably most important stock index globally, is that it had a very good start into the year, climbing from January to about, I think, the 22nd of February, followed by a very significant market correction by about 30% to one of its, to around 2,200 points. And then followed by, as I mentioned, a very fast recovery, which made us end the year probably around 10-15% above where we started the year. if you look, this is the S&P 500, so it is comprised of the 500 largest companies listed on US stock exchanges. If you look at something like the Nasdaq 100, which is focused on the 100 biggest technology companies, then the recovery would have been even faster and the returns for this year even higher. So we have seen a very tumultuous year, and we keep preaching the same 5-6 investment principles since the last like 18 months, where we do a year and a half where we do these webinars. And I think this year really shows that even in some of these most volatile environments, these investment principles still apply. And I want to spend now the next like roughly half an hour to go through them and try to share a little bit, like what can we learn from like this year and from these investment principles, which are like true since many years or decades. How can we use them and apply them in 2021? And then towards the end, I will also introduce Syfe and what solutions we offer. So I want to start with number one, which says it pays to invest today, or basically start as early as possible. Yeah. Why is that? I want to explain this based on an example. And in this example, there are two individuals. One is Chill and one is Check. And Chill and Check invest in the same securities, or they make the same investment, which both gives them a 8% per annum return. And each of them basically invests 10,000 per year. But the difference is that Chill already starts investing 10,000 a year when she's 30, and she does this only for 10 years, so only until she's 40. While Check starts only when he's 40, but then he does it for 20 years. So he does it from 40 all the way till he's 60. As I said, both of them having invested in the same, made the same investment, paying 8% returns per annum. So Chill invested a total of $100,000. Check invested a total of $200,000. So the question is now, who at age 65 will have more? And unfortunately, we can't really ask you to raise hands here, but so I'll go to the solution. But usually I'll ask people to guess, and very surprising for many, Chill, who has only invested $100,000, will actually have 1.15 million 35 years later when she's 65 years old. While Check, who invests for 25 years and even invests double as much, he invests $200,000, will end up slightly short of $800,000. So Chill will have almost $400,000 more than Check. And the reason for this is that she started 10 years earlier, which gave more time to compound the returns. And the effect of compounding can be seen here. So invest only half, but will have significantly more because she had 10 years more to compound the returns. Number two, and please feel free to ask questions. I see there's a few questions already coming in on the Q&A, but yeah, please feel free to ask questions, and I'll try to answer them. Maybe we'll make a short break after two of them to answer some questions. Don't put all eggs in one basket. So this is all about diversification. And Richard Ye, who is our head of portfolio construction, always says diversification is the only free lunch you can get when it comes to investing. Let's look at this very colorful chart, and let's pick one example. And the example we pick is, let's say, the dark purple one, which is real estate. As you can see, so every column represents 1 year. So this shows 2005 to 2019. And the higher you are up on the chart, the better the returns were compared to the other assets which are shown here. So if we are picking the example of real estate, you will see that in year 2, in 2006, it was doing fantastic. 35, almost 36% return in just a single year. But then it's followed by 2 horrendous years where it did minus 18% and minus 40%. Again, followed by 2-3 years where it does really well. And you can see that by that it sometimes it's very much on the top, and sometimes it's very much at the bottom. And you will see that this also is true for most of these other assets, that they vary very much between, you know, very good performance and very bad performances. So there is not one asset which is always doing great, but it's also always depends. And the same is true if you look at companies. Like some companies, they benefited from a situation like we had this year, like a pharmaceuticals company, for example, or a tech company. Some others were really hit very hard this year, but they might benefit from events happening in the future. So what you can see here on the gray portfolio, the gray boxes, is this is a diversified portfolio, meaning it's a portfolio which has a mix of these assets. And as you can see, in most years, they're somewhere in the middle, but in most years, they're actually performing quite well, right? There is actually only a single year in this 15-year period where they actually have negative returns. In all other years, or there's 1 year where they're flat and 1 year where they're negative. In all other years, they're actually having quite decent returns throughout this 15-year period. Number 3 is about managing risk. Or Hayden, do we want to take a short break and answer a few questions?
Yes, Seb. I think there's a few questions that are coming in that are quite interesting. We can take a few of them first. So one of the questions that came in was that, you know, now with COVID in the picture, there are a lot of reliefs in place in the economy. So is the adverse effect of COVID not that visible now? Would it come a bit later? And if it comes a bit later, what kind of investment strategies can we look at, you know, from a Syfe standpoint to avoid any potential crashes or dips in our portfolios?
Yeah, I think that's a great question, right? Yes, it's very obvious that the central banks globally made a huge effort in to support the economy. They provided a lot of liquidity to support the capital markets and so on. And for sure, this is part of why the economy or why the stock market did so well. I feel most of the relief packages and so on they have given is like, I think the effect of this was more limited on the stock market. I think this was really more targeted at, you know, helping businesses and individuals in the way to survive, right? So I think them stopping, I don't think that this will affect at least the stock markets as much. But of course, this can have an effect on some of these businesses. So I believe that, you know, the central banks are prepared to keep supporting, you know, like the stock markets over a longer period of time. I think there's multiple central banks who have already said that there will be a low interest environment for the foreseeable future, which I think will still like keep the stock market up. But as if you ask like what are the right sectors and so on to invest, like there's always like our point is always like really like having diversification, just what I just talked about, right? And having different sectors, different industries, different geographies in the portfolio, and some of them will benefit in different times, and this will really like set up your portfolio for success in the long term. One other question I see here is the diversification chart shows the performance of sectors every year, and they ask if there's a comparison chart which is sort of 5, 10, or 20-year periods. No, we currently don't have this when it comes to diversification. As far as I know, then this is something which is the same thing over like a relatively long period of time, but we don't have this chart. But we'll look at some other charts later on which shows it over an even longer period of time, but not in terms of diversification, but just in general, like when it comes about timing the market. And I think this will be quite interesting. There's a few more questions, but like I'll suggest we'll go ahead and I'll share 2-3 more points, and then we'll answer again a few questions. Number 3 is about managing risk over returns. What does this mean, or why is this important? This chart shows if there's a drawdown, meaning like your portfolio loses a certain value temporarily, how much does the return need to be to again basically recover and basically come back to the original amount? If the portfolio value goes down by 10%, an 11.1% increase in portfolio value will bring it back to the original value. But the higher the drawdown is, the more the recovery has to be. So with 30% drawdown, the recovery already needs to be close to 43% in order to come back to the original amount. And if your portfolio loses 50%, then obviously your portfolio needs to double to come back to the original amount. I know this is something quite obvious, but I think this shows, and I just want to it just shows and illustrates very nicely that it's very important to actually protect somehow the portfolio from volatility. It can be very hard to sometimes recover, and again, it's kind of a message to have a diversified portfolio, because this will make sure that the drawdowns are somehow more limited than if you put everything on the same horse. And so that means also then the returns, right, which you achieve, even with slightly lower returns but more consistent returns, you will have a better performance in the long run. Also, wanted to add this here is it's very hard to predict returns, right? But risk you can actually measure and manage, right? Even some of the best fund managers in the world cannot beat the market on a consistent basis. So there is some data by Spiva, which is a Standard & Poor's company, which basically shows that 90% of fund managers, active fund managers, cannot beat the market over a 10-year period of time. Yeah, because as I said, predicting returns of what is doing well is very hard. And I think again 2020 is a perfect example for that. Is who could have imagined what will happen this year 1 year ago, or somewhere in 2019, right? It's very hard to predict, but you can somehow prepare and manage the risk by diversification and a few other strategies, which we will talk about. Number 4, and then we'll answer again a few questions. Hayden is typing a few replies already, but we'll answer a few questions also publicly. Number 4 is stay invested. And I mentioned we'll show another couple of charts. And for this one, we have actually 2 different charts, which I think are very powerful. Here, this shows like a person who invested $10,000 in 2004 into the global equity MSCI World Index. So this is lots of like a basket of stocks worldwide. And what would have happened if you invest $10,000? And this you can see on this blue turquoise line, which goes starts from 10,000 and then reaches somewhere 35,000 in 2020. The highest was even above 40,000 sometime in the beginning of this year. What would have happened? How much would the same person have if they would have missed the 40 best days over this period? So we are looking over 16 years, and we just say out of 16 years, we just miss the 40 best days. And suddenly, actually, you have $26,000 less. You have actually less than you started with. You have $8,673 just by missing the 40 best days over the 16-year period. And this should show that, like, why is it important to stay invested? Is because it's very hard to time the market. You can just miss 40 days over a 16-year period and destroy a lot of your potential returns. Another chart which shows this, and it shows this over an even longer period of time. It shows this over almost 150 years. And what it shows here is, let's focus first on the top part, which says 1 year. This shows what was the return of the stock market in the US for a given year. And you can see it fluctuates quite widely. There are years where even the stock market even gained 50%. Yeah, 1932, again in like 1955, if I'm not mistaken, and so on. Many years where it came close to or even crossed 30%. But then at the same time, there are also actually quite a lot of years where it went down very significantly. You know? And you can see that there is, yes, the maximum you would have made if you would have exactly invested in the right year, it was 53%. But there's also years where you could have lost 37%. Yeah. So what would have happened if you stay invested for a 5-year period? And this is what the second row shows you. And what you can tell suddenly is that the number of red bars significantly decreases in terms of number of the bars, but they also became shorter, meaning that the drawdown was lower. So suddenly, the worst 5-year period over 150 years was 11.7%. So if you would have invested at the worst possible time in this last 150 years and stay invested for 5 years, you would have lost less than 12%. And now let's jump all the way down to the 20-year section. And you'll see that the red lines have disappeared. That means even if you invested at the worst possible time over a 150-year period, if you stick with your investment and keep it for 20 years, you will have made a return. You would have not lost money. So luckily, most of us, we will not be so unlucky to invest exactly at the worst moment. And we also usually don't invest everything at the same period of time. But you can tell that basically, if you stay invested, you significantly reduce your risk. And in actually over a 20-year period, in all cases, you actually recovered your losses and made a return. So staying investing is a very important principle when it comes to investing. And I think again, this year is a perfect example for this. And I want to jump one more time back to the S&P 500 chart of the last year. You can see that probably when like in March, beginning of March, it looked horrendous. But people who actually stayed invested, they would have actually now like benefited from it, right? People who would have maybe even invested more over this period would have even benefited even more, right? That said, Hayden, should we answer a few questions?
Yes, definitely, Seb. So I think one of the more popular questions that came in, of course, users want to know, considering how disconnected the economy is now with the market performance, especially in the US market, how can we look at partaking in the investments? How do they look at, how can they invest in such kind of market now? Is it better to look at a certain time, or like you mentioned earlier, to stay consistent invested, and how do they actually do it?
Yeah, I know this, like a lot of people would also would love us to always share like some secrets or like some tips on which stock to pick and so on. But the one thing which really has shown to consistently work is these principles which we are bringing up here, right? Is to like start early, right? Once you have started, stay invested. Don't put everything into one basket, but diversify, right? Some of the things which we are talking in the next 2 points is about cost, as well as like some other things. These are the things which I believe will like be the only protection to whatever will happen in the future, right? It's true that there is a certain disconnect from what's called the Wall Street and the Main Street, right? There's the unemployment is very high, while the capital markets are doing very good, right? But this has happened in the past, and especially if you look over periods like you can see on the screen right now, like over 150-year period, right? This is not that this happened for the first time ever, right? So I think all of the things which we mentioned still apply to this. Of course, there is ways to protect the portfolio more against volatility and so on, and we'll share a little bit later on what our global portfolio does in order to protect it from volatility. Is like you can shift towards bonds and other safer assets, or shift towards stocks in sectors which are known to be less affected by volatility, like energy, utilities, and so on. But I think that would also mean that you'll give up on some of the potential upside, right? So my like our point of view is still like to go with these investment principles which has been proven over a long period of time, rather than acting based on short-term market effects and what the government is deciding to do and so on. Yeah, so I think that would be my answer to that.
Right. Perfect. So there's also one more question that whether you want to take it now or a little bit later. So I think our viewers are also a bit curious, in terms of differences, what is Syfe's main difference between some of the other robo?
I think let us cover this in the later section. Because we basically here really show investment principles which not only apply actually to Syfe, but they can be applied even outside Syfe. I think what you will see later on then is so that a lot of the Syfe portfolios are built having these principles in mind, right? So I think they are, we promote and these kind of principles, but they can actually also apply to other things. So let's cover the Syfe part in just a few minutes after we went through the last two principles. The next principles which I want to talk about is investing costs or investment costs. And again, I want to just show this based on an example. Why are the costs of investment so important? Here you see 2 times the same investment. Both times starting capital is $100,000. The investment period is 25 years, and both investments return 6% per year. The only difference between the two investments is one is no cost, and I know this is usually not possible. There's always a cost somewhere, but makes it easy to understand the example. And one is a 2% fee per annum. And what you see after 25 years, the one who has no cost will have grown its investment from 100,000 to 430,000. So there's $330,000 of earnings. While the person who's paid 2% every year in fees has grown the 100,000 to 260,000. So the earnings will actually be less than half just because of the 2% in fees. And the reason is because the fees also means that you compound less, right? So these fees which go out, they are not again earning new returns on your investment, right? So this, of course, also basically assumes that all returns are basically again stay invested, and there are no withdrawals and so on. So even though you invested $100,000 over this 25-year period, this 2% will be $170,000. I think quite obvious why paying attention to cost is very important. Moving on, and I think this is just one very short one on this. Align investing with your goals. I think the worst you can have in such a situation where there's uncertainty and so on is unclear goals. And this is something I think everyone has to work on yourself, is to try to become clear on what are your goals, because then you'll see that there are investments which will be able to help you achieve these goals. Yeah, I think just if you have unclear goals, and then of course the financial market, there's always some uncertainty, you will be lost. So I think on your own defining what are your goals, I think is really crucial in order to pick the right investment tool to achieve this goal. Yeah, it's you will use very different tools or very different investments if you're investing for a 5-year period or a 20 or 30-year period, right? For a 20 or 30-year period, you will be willing to take more risk, because we have seen if you invest for a very long period of time, you'll basically recover any temporary losses and you'll make a good return. And so it makes sense to take more risk. While over a 3 or 4, 5-year period of time, you should reduce your risk, because you don't want to get you just don't want to get the timing wrong and just basically put it maybe in the wrong investment. So you want to take something which is relatively low risk. So, and if you know what your goals are, you will be able to know what's your investment horizon, and you will be able to also find out what are the right investment tools for you. So to summarize, it pays to invest today. So it means that basically starting early really has a very positive effect on your returns. The compound interest or the compounding will really kick in and really help to grow your investments. Diversification, or don't put all eggs in one basket. As I said, the one free lunch, it really like helps you to reduce volatility and will also make you sleep better at night. Then you want to manage your risk or returns. So don't just focus on what are the historical returns of an investment. As every ad needs to say, historical returns are not indicative of future performance. So look at actually understanding what are you investing in and try to understand the risks before you make a decision. Stay invested. I think we have seen this very clearly on the examples that staying invested really helps you to gain or to ripe to benefit all from the investments you have made. And timing the market can be very difficult and quite dangerous. You should minimize the investment cost. We have seen the effect of a 2% fee per year on your returns in the example. And if you have a goal, then you can make a plan, and then investing can really help you achieve your goals. With this, and before we talk about how Syfe can potentially help you, I would like to answer the few remaining questions on this, or are they all questions already regarding Syfe?
So the questions that are remaining are pertaining to, in terms of our portfolios and also that comparison between competitors. So
okay.
Depending on how you want to answer them first, or maybe after a few more slides down for you, Syfe.
Okay, sure. Then then we'll move into the Syfe section. Yeah. So Syfe currently offers 3 different portfolio options. We have the global portfolios, and I'm using plural here because these are you can choose between 11 different risk levels for these portfolios, and they consist of equities, bonds, and gold. And they are really like diversified across geographies, as the name suggests, but they are also across asset classes, as I already mentioned, equities, bonds, and gold, but also industry sectors. So this is kind of what we would suggest is a core portfolio, and yeah, really diversified. You can choose what is the right risk level for you between something relatively conservative to something a bit more aggressive. The Equity 100 portfolio is the right portfolio if you're looking for a pure equity portfolio. So it's 100% stocks. It's about 1,500 of them. Many of them you will know. There's like the Google and Facebook and Pfizer and P&G in there, but as well also like Chinese company listed in the US, such as Alibaba or Tencent. Has annualized returns of 13.2% over a 10-year period, and it uses a smart beta strategy to deliver better risk-adjusted returns. What does this mean? It uses certain factors to tilt the portfolio towards certain industries or factors, as I said. Like, so we are looking here at like large companies versus small companies, growth versus value stocks, and so on. And then our REIT Plus portfolio, highly popular, which we developed in collaboration with Singapore Exchange. It tracks the IHS REIT Leaders Index, which contains the biggest, so the largest and most liquid REITs listed on the Singapore Stock Exchange. It's attractive because it has a very high dividend yield of 5.1% in 2019. Has come down a little bit this year, but still at the same time also offers very attractive, like it also, the share price has come down a little bit, so it means it offers a good point to actually enter this market. And there you can choose between two different options. A risk managed option, which blends it with Singapore government bonds, as well as a pure REIT portfolio, which is 100% REITs only. On top of these three investment portfolios, we also offer a service called Syfe Advisory, which allows you to speak to wealth experts such as Hayden, who can help you with more individual, with your individual situation, which unfortunately I won't be able to cover here in this webinar. How does it work? And Hayden, please stop me at any time if you want me to answer any questions. How does it work? You'll start with a short questionnaire, which you answer a couple of questions, and at the end we will give you a portfolio recommendation. This portfolio recommendation comes also with a forecasting tool, where you see if you invest a certain amount X and a monthly subsequent deposits of Y, where would you most likely, in a most optimistic and in a conservative scenario, end up over a certain duration. And you can adjust these levers and see if it's the right portfolio for you. But not only this, it will also show you what are the stocks or REITs or whatever in the portfolio, and you can see in full transparency not only what are the stocks and bonds in the portfolio, but also what were the historical returns of the portfolio and so on. And then only then you actually make the decision, do you want to invest or not? If you then make the decision, you invest, then you see here on the right side how the dashboard will look like, how you can monitor your portfolio on a daily basis. I think I've already covered a few of the things which differentiate us from some of the competitors. I think our focus on the REIT Plus portfolio, which is a real estate focused portfolio, I think is something which is exclusive, available to us. I think some of this level of transparency we offer, I think, is also unprecedented, as well as the other portfolios. I think in this form or shape, they don't really exist somewhere else.
Right. So I think that was a good point you mentioned in terms of our REITs portfolio, something exclusive that we have here. So in terms of the REITs valuation now, some users are actually wondering, is it worth it to invest in them now? What kind of value are we looking at for the REITs market in Singapore?
Yeah. So it's a very good question. I want to answer like in two steps. One is, I just want to one more time refer to one of the points I made earlier, which is staying invested is really impossible, and it's very hard to time the market. I generally, apart from this, my personal view is that it's a good time to get started, because prices are still lower than they used to be. So it's below the all-time high. And I feel that, with a lot of this positive news on vaccines and so on, I think More people will go back to the office. I think they already announced now in phase 3 that the limitations gonna be lifted and so on. So I think there's a lot of signs which could mean that the REITs will further recover. But generally, I think, like REIT is like, if you look at it as a long-term investment, it's something which, you own piece of a land, you own a piece of a property, and even if in the short term they might be affected by a lockdown, which means less shopping or something like this, in the long term, either these restrictions will go away, or even if like people will really just shop more online, and less in physical outlets, then they will find new uses for these properties, right? Maybe some properties will turn into logistics for e-commerce. Maybe more people want to have larger apartments now that they're spending more time at home. So I think a lot of these effects will be short term, and in the long term, they will not matter that much. So from my point of view, I think it's a very interesting investment, and I think nothing against starting right now.
Okay, thank you, Seb. I think another question that came in was also, we were talking about, the forecasting tool that we have. Is
Yeah.
this currently available on the global portfolio and REITs portfolio, or all of it, or probably just the first 1 or 2 portfolios that we have now?
Yeah, no, I think that's so. As you can see on the screen here, right? So this is how it roughly looks like. It's definitely available for the global portfolios. For the equity 100 portfolio, I think we currently are not offering this, and the reason for this is that the equity 100 portfolio is 100% equity portfolio, and that means that there is volatility and there will be fluctuations, right? Unlike a global portfolio where there is a mix of different assets, which, as we have seen in the previous slide, like basically help to compensate for some of these corrections, this is not the case for equity 100. So that's also why, like, if you go through our risk analyzer, or like the questionnaire which you have at the very beginning, we only recommend the equity 100 portfolio for people who have basically shown in the questionnaire that they have a higher risk appetite, right? So if you invest in equity 100 portfolio, there might be more fluctuations than in some of the other portfolios. But as you have seen in this year, like this year, the portfolio is doing really, really well because there is a lot of technology stocks in there. So the potential returns of an equity 100 portfolio are obviously also higher. So that's why we only show historical returns, but we don't show a forecast, because especially on a shorter period, this might be quite misleading.
Okay, thank you, Seb. Maybe we can take one more question before you move on to the next portion. So I think some of our users are also a bit curious in terms of, the China exposure within our portfolios. There is some form of heavier weightage in terms of the US market for us. So in time to come, how are we going to incorporate China in response to this growing trend?
Yeah, I think it's a very good question again. I want to answer, like, again, two sides of this. One, it's true that if you look at ETFs and so on, it seems that there's a focus on US, Europe, some emerging markets and so on. But don't forget that actually a lot of these companies listed in the US have a lot of China exposure and will benefit from the development there. as well as there are Chinese companies which are listed in the US. I think two of them I mentioned already, which is Tencent and Alibaba, right? So even though they are a part of S&P 500, they are Chinese companies and they will benefit from the economic development there. The other part is though that we are reviewing regularly our portfolios, and we might be adding a higher, or we might increase the exposure to China specifically sometime early next year. So stay tuned. There might be some news early next year. We are constantly looking at this, and we might make the decision early next year to increase the exposure to China. Yeah. One more question I want to answer. I think Liza asked, how is the growth of the portfolios for 2020 so far? And as I mentioned earlier on the slide where I said like the forecasting tool, we show in full transparency how was the returns of the portfolio in 2020. The reason why we're not really covering it in the webinar is because there's 13 different global portfolios, and even the global portfolio is different for every client depending on when they join, right? And then there is the equity 100 portfolio, and then there's two different REIT portfolios. So we would basically need to show a total of 14 different portfolios here, which would not be very good. So it's the easiest is actually to just go through the risk to the risk analyzer, to the questionnaire, and then you will be able to see all the different portfolios and see the returns of them. I think before we answer the remaining questions, let us move on and show a couple of other benefits of investing with Syfe. One is that we have no trading fees, no entry-exit charges, no minimum balance, so you can theoretically start with as little as $1. You have unlimited and free withdrawals. Whenever we rebalance, this does not come as any charge to you. And we choose ETFs with the lowest management fees as one of the criteria on how we choose ETFs. I know there was a question about why not buy REITs directly by an anonymous attendee. So the question was, now that there is, like brokers out there which charge as little as 0.12% and very, very low custody fees, why would I come to Syfe, to buy it? I think there's multiple reasons for this. One is, even though brokerage fees are sometimes very low in terms of percentage-wise, they have often a minimum amount. So this ranges anywhere from 10 to 25 Singapore dollars. So if you buy, like in our case, 20 different REITs, and you're not buying like $1 million worth of REITs, then you will often hit these minimums, and instead of the percentage, you would actually pay this minimum amount, which, as an example, if it's $20 per REIT and you buy 20 different REITs, you will already pay $400 in fees just to buy. And if you sell, you would pay again this $400. Next point is, if we rebalance, right, and the REIT index, or the index which we are tracking, the SGX IHS REIT Leaders Index, rebalances twice a year. So twice a year, you would again have costs to do this rebalancing. So in a perfect example of where you really just pay the 12 basis points as the viewer asked, you would pay 12 basis points, so 0.12% when you buy. You would pay it twice a year when you rebalance. You would pay it again when you take it out. You would pay again any time in between. Yeah. So even this already stacks up to a loss. In case you want to you want to like top up, and maybe your initial amount was big enough to really only pay the percentage. For the top ups, you might not invest as much, so you might be able to you might have to pay the minimum fees there. And I think this is something which is also important for many of our clients, is they know that we basically are taking care of everything, right? So if there is a rights issuance, we will take care of this. If there is any other actions which need to be taken, we will do it. We will basically fully manage the portfolio, and all you need to do, or all you can do, is basically check from time to time through your mobile application on how your portfolio is doing. Yeah, so we have talked a lot about some of these features. Let's move on to the pricing. So we charge between 0.65% to 0.4% per annum, depending on how much you invest with us. Below $20,000, so for as little as $1, you pay 0.65% per annum. And just to give you an example, on $10,000 which are invested with us for one year, you would only pay a little bit more than $1 per week. Which includes the brokerage costs, trading costs, custody fees, etc. Above $20,000, we reduce the fee to 0.5% per annum, and above $100,000, we reduce it to 0.4%. Above $500,000, we usually do, not only like review the management fee, but also can create a kind of a custom package for you. All of this also comes always with access to wealth experts, which really, as I mentioned earlier, can help you with your individual situation and go into more detail what would be the right investments for you. I think some of this we already covered when I answered the previous question. If you invest yourself, right, you are subject to minimum amounts. You require a CDP and a brokerage account. Sometimes this can take several days to open these accounts, while with us, you don't require a CDP or brokerage account. Your assets are still kept with a custodian, which is HSBC for all Singapore listed securities, and Citi for all other securities. And you can open an account in less than 3 minutes using MyInfo. We offer risk management on the global and the REIT portfolio. We automatically rebalance and re-optimize your portfolio. And something which is again a big advantage of investing, especially for REITs with us compared to doing it yourself, is we automatically reinvest your dividends. So let's say you have 5% dividends per year and you invest $10,000, right? 5% of $10,000 would be $500. To invest and these $500 don't even come all at the same time. They come throughout the year. Usually every REIT pays roughly twice a year. So these come in lots of small amounts. For you to reinvest this through the traditional broker is very hard, while we automatically reinvest this for you. As I mentioned, brokerage fees are included in your management fee, and management fees start as little as 0.4% per annum. Yeah, with this, we come to the end of today's session, but I will still take time to answer the remaining questions.
Right.
In the meantime, please like scan this QR code and provide feedback to us. It's just 2 or 3 questions, and you'll get a promo code at the end of it, which allows you to get 6 months fee waiver. Hayden, should we answer some of the questions which are still there?
Yep, Seb. So there's a few more questions. I think these are really good ones too. So I think one of our viewers are also asking, in terms of our global portfolio and our equity 100 portfolio being in US dollar, do we have any hedging done for the US dollar depreciation against Sing dollar? Or maybe the cost of hedging is quite expensive and we don't do any form of hedging in that sense.
Yeah, actually, you're right. It's a fantastic question. So the global and the equity 100 portfolio are US dollar denominated. Why is that? Because still, like, the biggest capital markets are US based. We get the best, we can access the best ETFs there, which provide, they have the highest volume, which means they have the best liquidity and so on. So that really ensures that when we buy and sell securities on your behalf, we can sell them, we can buy them and sell them at the best possible price, right? And the spread between buy and sell is very, very small. The REIT Plus portfolio is Singapore dollar denominated, so there is no currency risk for you. We looked into hedging the US dollar denominated portfolios, but have seen, and we simulated this over a long period of time, and we could see that the cost of hedging are higher than the gains from hedging. So that's why we have decided actually to not hedge. And luckily, right, the US dollar is still the reserve currency of the world, which means that it should be a very good currency to hold your investments in. And the good thing is also that we are charging a very low FX rate when you're transferring or when you're converting your Singapore dollar to US dollar, which is below 0.1%. Actually, this is our broker is actually charging this, and we are not taking any cut of this. So we are charging you exactly what our broker is charging you, and these are pretty much the best rates you can get in the market. If you go to your own bank and would do the conversion, it will cost you multiple times more. I hope, Hayden, this answered the question.
Yes, Seb, I think that's a good answer for that. At the same time, another viewer has been wanting to know, in terms of their assets with us, are there any custodian accounts in place to safeguard their assets from Syfe?
Yeah, so it's a very good question. So one very important point is we are licensed by the Monetary Authority of Singapore. We are a Singapore-based fund, and we are closely monitored by TMAS, who are basically with the stringent requirements, basically ensuring that clients' funds are safe. Some of these requirements are, for example, that we are not allowed to commingle Syfe's funds with our clients' funds. So all the Syfe funds are strictly segregated from our clients' funds. If a client invests with us, the client transfers funds to a so-called trust account with DBS. It's called the Syfe client trust account. And from this account, where there's only client assets, we will basically start to invest. As I mentioned earlier, all the funds and all the securities which we purchase for clients are held with custodians, which are HSBC and Citi, which are among the largest financial institutions in the world, who are doing this also for a lot of other brokers and so on. So this is very safe there. On top of this, there is base capital requirements which we have to fulfill. so that in case, even if something would happen to us, that basically clients do not lose their funds which they have invested with Syfe. And if this would happen, then MAS would appoint another fund manager to manage the funds of the clients, or if the client decides so, withdraws, to basically sell the asset and return the funds to the client. One person, I saw a question about dividend reinvesting. The person got $200, got $200 in dividends, and it's still in cash. We always keep a very small amount of cash in the portfolio, right? This is true for actually all types of portfolios. But as soon as this becomes slightly more than the threshold, we'll invest it. So I guess this $200 for your portfolio size is relatively small, so that's why it's not yet invested, right? But usually the cash amount in your portfolio should always be actually like below 1%, except for very short periods of time. But usually it's below 1%, and everything else will always invest, so you can make the best possible returns on your investment.
So, Seb, I think this question has came out a few times today, and I think for the benefit of some of the viewers that came in a bit later, perhaps we could conclude with this as well. So the question would be that, the investment strategy that we should be looking at, when the market is so disconnected, perhaps we could reiterate and emphasize on this one more time for the viewers that came in a bit later.
Yeah, as I mentioned, right, like in my opinion, like what's and this was the whole webinar was about this, right, is to really think about what are your objectives, right, and then start investing in line with your objective and stay invested, stick to your strategy, be disciplined, and history has shown that you will benefit, right? The capital markets do not mirror the economy necessarily one-to-one. Like, it doesn't mean that higher unemployment is necessarily mean that the capital markets and the stock market need to go down as well, right? At some point, this can affect the capital markets, but they don't have to, right? And usually, when there is after periods of downtrends, there's periods where it recovers, right? And so I wouldn't. I think this is generally, yes, of course, a concern, but I think also the governments have learned a lot from 2008 and so on, where they were a little bit slow to react. But this time they have reacted very fast, and they have reacted with a lot of very strongly, right? Not only fast but also strongly, by putting serious amounts of money, which really helped to the economy to hold up, and the stock market benefited greatly from that. Cool. Hayden, any other questions, or should we wrap up for today?
Thank you, Seb. I think we've answered all of the questions from our viewers tonight, and we've concluded with that investment strategy during this kind of disconnected time. Thank you, Seb.
Great. All right. Then thank you very much for joining us today. It was a very interesting conversation. And please feel free to get in touch with us through support@syfe.com, or schedule a call with one of our wealth experts through our website. On the advisory section, you can actually schedule a call and speak to one of our wealth experts. Thank you very much for staying with us that late, and hopefully see you soon at one of our next webinars. Have a good evening.
Bye-bye.